Documenting assets is one of the most difficult parts of the loan process in the post-mortgage meltdown era. The reason you'd have to document assets is to do three things mainly. Number one, show that you have plenty of money to bring as a down payment or cash to closing. Number two, show that you have money in what are called reserves, which essentially just means savings in case you lose a job, lose a renter if you own a rental property, etc. Then you have money to fall back on. Number three, in a refinance transaction, the new loan amount doesn't cover all the costs, so you have to bring money to closing. But there are also other, more specific times when you would need to show your bank account statements in the same way, even if you aren't needing the balance to approve your loan. For example, when you write an earnest money check for a purchase, your lender will need to see your bank account to show that it cleared the bank in order to give you credit for that deposit. Your entire 60 days of statements will be required and will come under review. Another example, if you were to receive a gift for a down payment, your entire 60 days of statements prior to that gift being deposited will be required and will come under review. If someone is gifting you money for a purchase or even a refinance, their entire 60 days of statements will be required and will come under review. These are just the most common examples. But why? Why all this documentation, and what are they looking for? The issue is, underwriters are charged with calculating your true ability to repay a loan. That ability is heavily weighted on a ratio called your debt-to-income ratio. The amount of debt you have is figured in various ways throughout the process. But where assets come into play is when you have to show money, you have to show that you truly have an asset, meaning it has no offsetting debt that has a monthly payment that hasn't been factored into that debt-to-income ratio. If you have another loan and you deposited the funds into your account, that's how the underwriter will look and will find out. They also know that the money can get transferred to and from bank accounts instantaneously. In the post-mortgage meltdown era, these are the things you must prove to the underwriter that you are not doing. Gone are the days where you could send in a picture of a few transactions with a recent balance. So let's look at how to document your money correctly. For all these examples, we're just going to use a purchase price of $100,000, assuming a 3.5% down payment to illustrate how the general process works. Basic bank accounts. Let's say you're closing on a house October 30th. And the way this particular purchase is structured in this example, you would need $4,000 at closing. But when you put a contract on the home, let's say you put down a $500 earnest money deposit that the seller cashed. You'll get credit for that deposit, so now you only have to bring $3,500 at closing. You have to show that you have enough cash in your bank account to cover the money you need to close. You must provide 60 days worth of transactions, which is usually 2 months worth of statements, from the account out of which your down payment and or closing cost will be drawn. So assuming your bank runs on a 15th to 15th statement cycle, let's say you provide statements from August 15th to September 15th and September 15th to October 15th statements. That would be sufficient. Let's say you have a checking account with a current balance of $4,000. Even if August 15th to September 15th statement had a balance of $3,000, your lender would take the latest balance of $4,000. But let me show you why this part is so difficult to understand. Let's assume the deposits into that account were mostly payroll deposits from your paycheck at work, but you like to move money. Obviously, you do not want to be moving money faster than your balance, so no bounce checks or overdraft fees. Those are not deal killers necessarily, but they can be. But let's say you have a savings account with the same bank that you transfer money to, often from the same checking, so you can earn interest on that money when you don't need it to pay bills from checking. Let's say you had 10 transactions throughout those 2 months where you deposited a total of $600 from that savings account into your checking account. And let's say you moved $700 to savings throughout those 2 months, but you took back out $600 and transferred those back to your checking. Here's the thing. If there's a lot of transferring going on, your bank account is no longer able to stand on its own. It is a function of every other bank account to which and from which money goes. So you now also need to provide the 2 months of recent statements of that savings account. Why? Because if you didn't provide those, your lender would have to take your current checking balance of $4,000, but reduce it by the $600 you transferred from an account for which they do not have statements. Now, if you need $3,500, you're not good. So you then need to provide the savings account statements out of which you transferred those deposits. Let's say you started the home buying process 5 months ago. When your grandma found out you were looking for a home, she gave you $5,000 once you found a home that you directly deposited into that savings account on August the 16th. The statement dates you gave your lender for savings were from August 15th to September 15th, and from September 16th to October 15th. Her $5,000 deposit is going to show up in your statement. But unless you provide grandma's 2 months of bank statements showing where she had that $5,000 to give, you cannot count that as part of your money. You would also need a gift letter from her stating you are not expected to repay it. The point is, every movement of money, every deposit matters and needs to be shown that it is not a loan and that your balance is your balance.